So these ratios that we're going to look at now are particularly useful to investors in a company, both banks and shareholder investors. And throughout the slides, I'll be referring to the examples that I sent out in the second set of ratio calculations. You'll find these in the same place as the videos on the website. I'm also going to include in this presentation a couple of ratios that aren't actually in the syllabus, because I think they're really important from an investor's point of view. They're used a lot both in the press and elsewhere for investors, and I don't really understand why they've been missed out of the AAT syllabus. But from the point of view of learning about the ratios for use in the workplace, then I think it's important you have a knowledge of those. But just bear in mind the last couple of ratios you won't find in the textbook. So when we think about investors, they're generally interested in one of two things. Firstly, what return they're going to get on their investment, and secondly, just how secure their money is, how much risk is there of them losing the amount they've put into the business. And we'll be looking at this from the point of view of shareholder investors, but also banks that lend money to the company on a long-term basis. And yes, remember, banks have a priority, everyone has a priority over shareholder investors. The banks will always get a return on their investment before shareholders do. If there's not enough money for the shareholders, the banks will still get a return on their investment. Remember also that shareholders will get a return in one of two ways. Yes, they might receive dividends paid to them out of profits, but we don't particularly look at dividend payments when we're assessing investment performance, because if the company doesn't pay a dividend and it retains the profits within the business, then the result should be that the share price will increase to reflect that. So shareholders will get a return in one of two ways: either a dividend in their bank account or an increase in the value of their investment. And the ratios that we'll calculate look at the total of those two, really. So the first ratio to look at is return on capital employed. This is one that's rarely missing from the financial statements exam, and it looks at the overall return that both groups of investors get from a company, both the banks and the shareholders, and it's the average return that both groups get on their investment. The formula is there. We take the operating profit, remember to use the correct figure, it's the operating profit divided by the total equity. Don't make the mistake of using just the share capital figure. It's the total equity plus the amount of long-term loans that banks have made to the business. And if those aren't separately identifiable, then treat the long-term liabilities, the non-current liabilities figure, as being all long-term loans. And it's worth looking at how that calculation can be broken down. If we look at the examples that you should have available, if we look at the first year, we can look at both groups of investors. If we first of all consider the bank as an investor, they've invested long term a total of £50,000 in the business. their pre-tax return on that investment is the interest they get, and that's the finance costs figure in the profit and loss account. So they've got a return of 15,000 on that investment, and that gives them a return of 30%, a pre-tax return of 30%. If we then look at the shareholders, the shareholders have got 407,000 invested in the business. That's the equity total from the balance sheet. Their pre-tax return is the pre-tax profit figure after the bank's return of 15,000 has been deducted from the operating profit. So they get what's left after the bank have had their share, and that gives them a return on investment of 21.38%. The return on capital employed calculation combines those two. So in total, those two groups of investors have got 457,000 invested in the business. That's the operating profit figure. And in total, those two groups of investors get a return of 102,000. That's the bank that gets 15 and the shareholders that get 87. And that gives us an overall return on total capital employed of 22.32%. So we take the total equity figure and the non-current liabilities figure and work out what the operating profit figure is as a percentage of that, and that gives us the return on capital employed. So it combines the return that both groups of investors, banks and shareholders, get from the money that they've put into this particular company. Now, as with all ratios, there are some limitations that you need to be aware of when you're looking at return on capital employed, particularly when you're comparing one year to another. And the first important thing to remember is that the calculation that we use, certainly in the AAT exams, assumes that the capital available at the end of the year has been available throughout the entire 12-month accounting period, or however long the accounting period is. If new capital has been introduced during the period, the calculation assumes that it was introduced on the very first day, and that's not always the case, and it will give rise to distortions in the return on capital employed figure. Here's an example. If we've got a year end 31st of December, if £10,000 is invested on the 1st of January and the return on capital is 10%, that's going to give you a return of £1,000, and the return on capital employed figure will be 10%. If, however, that £10,000 is only invested in the business halfway through the year, then even though the rate of return is still the same for a full year, then in this particular case the accounts would only show a return of £500 in the year in which that money is put into the business, and your return on capital employed calculation, if you use the formula that we've shown on the previous slides, that would give you a return on capital of only 5%. And so if you just looked at those two figures without an understanding of how they've been calculated, you would say that the return on capital's lower in the second case, but that's not true. It's only lower because the new capital that's been put into the business wasn't there for the whole of the accounting period. Just so that you're aware, in more detailed calculations, you won't be expected to do it in the exam, but in more detailed calculations, sometimes the average capital is used rather than the year-end balance sheet figures. The return on capital employed calculation uses the average of the opening and closing figures, rather than just the ones at the year end. So if you've got an exam question where the return on capital employed has gone down, and at the same time you can see that new capital has been put into the business, then it might be worth making the point that the calculation assumes that that's been available for the whole of the accounting period. Another difference that you need to be aware of is that when you're working out the capital employed figure, it uses the balance sheet values. This might be less than the actual amount of capital employed if the assets in the balance sheet haven't been revalued. And here's an example of that. In year one, we've got capital employed of 200,000 and an operating profit of 16,000. That gives us a return on capital employed of 8%. Maybe then we want to revalue some of our assets, and as a result of that we create a revaluation reserve of 100,000. That's included in the equity total that's taken into account when we're working out the return on capital employed. If after that we still get an operating profit of 16,000, our calculation will show that the return on capital employed is less. It's only 5.33% instead of 8%. And the only reason it's gone down is because of that valuation. It's not because we've been less profitable or less efficient in the management of the capital. So bear those two things in mind that do create limitations when it comes to interpreting changes in the return on capital employed. Another thing to bear in mind is that sometimes companies will have a cash surplus that's just put on deposit. That will have an effect on the return on capital as well. And as I've already mentioned, in real-world calculations, you can refine the calculations by taking the average capital employed rather than just the year-end figure. But for the AAT exam, it's the year-end balance sheet figures that you will use. So if we have a look at the figures in the example that I've issued, if we take year one, we've got capital employed of 407,000 from shareholders, 50,000 from the bank, so total capital employed is 457,000. The return on that investment is 102,000. That's the operating profit, and using our formula, that gives us a return on capital employed of 22.32%. If we then look at year two, we've got total capital employed of 544,000. Equity's gone up and loans have gone up as well. So we've got total capital employed now of 544. The operating profit in year two is 100,000, and that gives us a lower return on capital employed of 18.38%. When we come to commenting on those figures, it's sensible to have a look and see what's happened overall in the period. And things to bear in mind are, firstly, there's been a new issue of share capital, an extra 55,000. We've also obtained some extra loans. Those have gone up by 30,000. And remember from the previous slide, the calculation assumes that that extra capital has been available and used throughout the whole accounting period. The other thing to note, if you look at the balance sheet, the book value of property, plant and equipment's gone up by at least £100,000 during the year. So that suggests that that's where most of that extra investment has been used up. So what might we write in the exam if we were asked to comment on these changes between years 1 and 2 in the example? This is just a suggestion, but always start off by stating what the changes are. I always recommend you write an answer on the basis that the person you're writing to doesn't have the figures available, doesn't have the sheets of information available. So start off by saying what's happened. Capital employed has gone up by just over 19% from 457,000 in year 1 to 544,000 in year 2, and then explain why that is. And as I've said here, it's mainly because of an additional share issue and extra loans. And I've also mentioned there that that extra capital is probably what's been used to fund the purchase of additional plant and machinery that's gone up by quite a lot in year 2. So once we've commented on what's happened, we can work out the return on capital employed and comment on that. And as I'm saying here, although we've got extra capital invested in the business, the return on capital has actually gone down slightly from 22% to 18% in year 2. And this is partly due to a reduction in operating profit brought about by increased overheads. Don't make the mistake of commenting on the fact that finance costs have increased in the profit and loss account, because those are treated as part of the return on the investment. So to say that the return's gone down because finance costs have gone up would be incorrect. It's the operating profit figure that we're looking at, not the profit before tax. And then I've mentioned that last point again, that the calculation assumes that the whole of the extra capital was in use throughout the period. And if that's not the case, then hopefully next year the return on capital will have gone back up again. So the last ratio looked at the overall return that both groups of investors, banks and shareholders, obtained on their investment. The next calculation that you're likely to come across is the return on equity, and as the name implies, this is only looking at the return that shareholders get on their investment rather than shareholders and banks. Now, it's easy to make a mistake here because unlike the return on capital employed, which uses the pre-tax profit figures, the return on equity uses the after-tax profit figure. That can be confusing if you don't remember that. So return on equity looks at the profit after tax as a percentage of total equity, and again, don't make the mistake of including just the share capital. It's the total equity figure in the balance sheet that you use in that calculation. And so we're not looking at dividends, as I've mentioned before. It's the total net profit that is the return to the shareholders, even though they won't get all of that paid out to them, because in theory anyway, if the profit's retained in the company, that should be reflected in an increase in the value of their shareholding. So if we have a look at the examples, year 1, there we've got a profit after tax of 81,000, total equity 407,000, and that gives us a return of 19.9%. And year 2, similar figures: profit after tax 65, total equity 464, and that gives us a return of 14.1. So how might we write an exam answer about the changes in the return on equity? Here's a suggestion. We're first of all setting out what the situation is. Return on equity has gone down from 19% to 14%, even though share capital has increased during the period by 55,000. And that's largely because the profit after tax has gone down as well. And as I'm saying here, there could be many reasons for the reduction, but the main ones are the large increase in overhead expenses in year 2. Remember, admin costs have gone up by a very large percentage, and finance costs have also increased due to additional loans being obtained during the accounting period. And again, I've just mentioned that it assumes that the extra 55,000 of share capital was available and in use for the whole of the accounting period, which may not be the case. So we've looked at the returns that both lots of investors are receiving, banks and shareholders. The next ratio that we look at compares the amount of money that banks have got invested in the business with the amount of money that shareholders have got invested, and that's referred to as the company's gearing. And one thing to bear in mind, there are two different ways in which this gearing ratio has historically been calculated. Firstly, we can look at the amount of money banks have put into the business, the long-term bank loans, and compare that to the amount of money that shareholders have put in the business, and express that as a percentage. The other option is to compare the amount of money that banks have put in and express that as a percentage of the total amount invested in the business. So in this case, we take the long-term bank loans and we express that as a percentage of the total amount of money invested in the business. And if you remember, this will be the same as the figure that we use for the return on capital employed calculation. So we take the long-term loans and total equity, and we say what percentage of the total invested in the business has come from banks, and that's the calculation that's to be preferred. That's usually the one that will be expected in the exam. If you've got no other indications, then use that as the calculation. What you can do sometimes in the exam, you might get a question where 1 year's ratios have already been calculated for you, and you have to calculate the second year. This is a bit of a bonus, because it means you can, if you're not sure of the formulas, you can check that you're using the right formula by attempting to recalculate the figures that are provided for you, and that will be one way of working out which of the two options have been used to calculate the gearing, either the long-term bank loans as a percentage of the shareholder investment, or the long-term bank loans as a percentage of the total amount invested in the business by both banks and shareholders. And as I say, that's the calculation that's usually to be preferred. So there are some important things to remember when it comes to looking at the gearing calculations. Firstly, remember that shareholders only get a return after everybody else has been paid. Shareholders will only get a dividend if there is any profit left after the banks have been paid their interest. If there's no profit, there's no dividend for the shareholders. That's not the same with banks, however. Banks will still get an interest payment even if the company makes no profit during the year. The company will still have a liability to make that payment to the banks. So there's a big difference between the two groups of investors there. And as I've said, the banks have preference over the shareholders. The banks will get their interest before the shareholders get any dividend. If there's only enough money to pay the interest, then shareholders get nothing. If a lot of the money invested in the business comes from banks, then it's more likely that firstly, shareholders may not get a dividend, but it's also a possibility that the company could start running into a loss-making situation, because even if there are no profits, banks will still have to be paid their interest. And that means that capital would be used up paying that interest to the bank, which is not a good idea. Now, when we come to analysing the gearing, generally investors will split the percentages into three categories. If more than 50% of the money invested in the business comes from banks as opposed to shareholders, that's going to be referred to as a highly geared company. A highly geared company is one that's obtained most of its money from banks rather than from shareholder investment. And a highly geared company does run the risk of running into financial difficulty if it doesn't make sufficient profits to cover the interest payments, and it's more likely that there won't be enough money to pay dividends to shareholders. So that's more than 50% from the banks. Between 25 and 50%, that's what's sometimes looked at as the optimum gearing ratio. And as I've said on the slide, when companies approach banks for a long-term loan, banks will often take the view that they're prepared to put in as much as the shareholders have put in, but no more. Banks would be very reluctant to have more than 50% of the investment. So between 25 and 50% is considered a reasonable ratio for gearing. If it's less than 25%, if more than 75% of the investment comes from shareholders, then that's a low risk in terms of lenders and shareholders as well. Shareholders are much more likely to get a dividend from one of those companies, because there's very little of the profit that's going to be used to pay interest to banks and other lenders. So if we look at the examples that you should have a copy of, year one, the bank have got 50,000 invested in the business, and the shareholders have got 407,000 invested in the business, so total investment 457,000. That gives us a gearing of 10.94%. Just under 11% of the total investment comes from banks, so that's a very low gearing. And then if we look at year two, we've got 80,000 invested by the banks, 464,000 from shareholders, and that gives a gearing of 14.71%. So still very low in terms of the percentage of money that comes from banks. So what might we write about the gearing if we had to in the exam? Here's a suggestion. first of all mention what's happened. It's increased from 10% to 14. Why has it increased? It's because share capital has gone up by 55, but long-term loans have gone up by 30,000. And because it's such a low gearing ratio, we can say what I've put on the slide there, that the majority of the investment still comes from shareholders. So it's unlikely that the company will have any difficulty making interest payments to the banks, and so on. The final exam ratio that I want to have a look at then is the interest cover calculation. This is one of the few ratios that isn't expressed as a percentage. So don't go calculating a percentage for this. It simply looks at the finance costs and the operating profit, and works out how many times the operating profit could cover the interest payments. So there's the formula. It's simply the operating profit divided by finance costs, and that will give you a number of times that those costs can be covered by the operating profit. And the general rule is that the higher that figure is, the better. The higher that figure is, the less likelihood that the company is going to run into trouble. If it's a high figure, it means if profits go down, the likelihood is that they'll still be sufficient to cover interest payments and also leave enough for the shareholders to receive a dividend at the end of the year. If the figure's very low, then there's more of a risk that the company will make an operating profit that's less than their commitment to pay interest to the banks, and that would use up capital, and it would mean that the company would be recording losses in their profit and loss account. And if the figure is only 1, then clearly any reduction in profit would mean that the company was in a loss-making situation, and it would also mean that there's just enough operating profit to cover the finance costs, but nothing left for the shareholders. So, as I said earlier in the slide, we're really looking for as high a figure there as possible. So if we look at the examples, in year 1 we've got an operating profit of 102,000 and we've got finance costs of 15. That gives us interest cover of just under 7 times. The operating profit is 7 times as much as the money going out to banks in finance costs. And year 2, the profit's down to 100,000, finance costs are up to 20,000, and that gives us an interest cover of 5 times, which is a bit lower than year 1, but it's still quite a good amount of cover. So what can we write about if we're asked to comment on these interest cover calculations? First of all, again, set out exactly what the situation is and give an indication of what's happened to give rise to the change. So interest cover's gone down from 6 times to 5 times, partly because operating profit's gone down, partly because loan finance costs have gone up. But then we can comment that the interest cover is still quite high, and so even if profits do go down again in the following year, there should still be sufficient money to cover any interest payments and also leave sufficient profit for the shareholders. So there are 2 ratios now that I want to make you aware of that won't crop up in the exam, but they are important. The first of those is the earnings per share, and if you look at some of the published financial statements that we've had copies of to look at, you'll see that at the bottom of the profit and loss account, the income statement, companies will usually give a figure for their earnings per share because it is so important. It's one of the most commonly used ratios by shareholder investors. And it's a bit like the return on equity calculation, and there's the formula. It's the profit after tax. Remember, that's the figure that's used for the return on equity, and it's the profit after tax divided by the number of ordinary shares in issue. And it's important to remember that it's the number of shares, not their monetary value. So it basically says how much profit is earned by the holder of one single share in the company. The calculation can get somewhat complicated if there have been additional shares issued during the period, or there have been bonus issues during the period. But as I say, this isn't something that will crop up in the exam, but it is something that really, as an accountant, you should be aware of. So here's a quick example. The company's got £50,000 worth of shares in issue, and they've each got a nominal value of 50 pence. So the number of shares is actually 100,000. If the profit after tax is £45,000, then the earnings per share will be 45 pence. And just a reminder there that it's the number of shares, not their monetary value, that's used. Because of the fact that we're using the number of shares, then it's difficult to compare one company's earnings with another company's, because if the nominal value is different, then the earnings per share will be different. And in the example given above, if the nominal value of each share was £1, then that would give an earnings per share figure of 90 pence, even though the amount of capital and profit in monetary terms is exactly the same. So it's difficult to compare one company with another. However, this earnings per share figure is used as a component in calculating what's termed the price earnings ratio. And the price earnings ratio is the ratio where figures are comparable, and it's calculated in this way. We look at the market price per share, so we're only talking quoted companies here. The market price per share divided by the current earnings per share. So the figure will tell you how many years, it's not a percentage, the figure will tell you how many years it will take based on current profits for an investor to receive a return equal to the amount of their original investment. So how many years will it take for me to effectively get my money back? Now, if the price earnings ratio is a high figure, that means it's going to take a long time based on current profits for people to get their money back. And that's probably an indication that investors are likely to think that profits will increase in future. If the price earnings ratio is low, then that might be an indication that investors don't expect profits to rise very much. Lots of other things affect the price earnings ratio. Economy, coronavirus, and so on will all have an impact on share prices. But as I say, it's what investors use to judge companies. It's the figure that's published in the FT and in the financial press. And Here's some examples of price earnings ratios at April 2020. BT have got a price earnings ratio of 5.77. So it would take, if you bought £100 worth of shares in BT, then on this basis it would take just under 6 years for you to get a return on your investment equal to what you've put in. EasyJet take a bit longer. Next, price earnings ratio is 10.48. Now obviously the current profits are going to be lower than investors would hope they'll be once the economy is up and running again, so that's in anticipation of increased profits. Same with Whitbread. Their Premier Inn hotels aren't generating much of an income at the moment. Hopefully that will go up in the future. JD Sports, the same, even more of an anticipation of increased profits. And Tesco's have actually got a price earnings ratio of 34 at the moment, which seems to indicate that their future profits are going to be much, much higher than those that were used to calculate that ratio in the first place. And I think that's probably because they've now disposed of some overseas businesses connected with Tesco. I can't remember whether it's India or in the United States that they've disposed of some business interests there, which were loss-making, and so hopefully their profits will go up in future. So price earnings ratios are an indication really of what investors expect businesses to do in the future, and they are widely used. But these are, as I say, two ratios that you will come across in the press, two ratios that are used quite a lot, but for reasons that I don't quite understand, both of them don't appear as ratios in the AAT exam. But you need to be aware that they're there.